365 divided by net credit sales. You can take this average receivable to the denominator, then it will be net credit sales divided by average receivable. This is net credit sales divided by average receivable is what you have just seen, that is the receivable turnover ratio. 365 divided by receivable turnover ratio. So collection period is equal to 365 divided by receivable turnover. So if you want it in days, you have to really divide it by 300. You have to divide 365. So this is in days. This is day sales outstanding. So this is the, let me take it as collection period. If you want it in days, this is the formula: number of days in the year divided by receivable turnover ratio, right? If you want it in months, what should you do? You will divide 12 divided by receivable turnover ratio. If you want it in weeks, what should you do? $52 divided by receivable turnover ratio. Really, you understood this? How much period you take to collect your receivables? If you want it in weeks, 52 divided by receivable. What is receivable turnover ratio? That's the activity ratio we have just learned. Net credit sales divided by average receivable. You have that number, means 52 divided by average receivable turnover ratio. Receivable turnover ratio will give you the collection period in weeks. If you want it in months, 12 divided by receivable. Collection period in months, if you want it, 12 divided by this thing. But give me half a minute, I will just show it. Let's work with the days. So days, collection period in days. This is 365 for the average net credit sales published number. You have 365 days to generate that. So how many days you need to collect your receivables? And then when you have taken this average receivable to the denominator, you had a format. This is 365 divided by receivable turnover. This is one useful format. Another useful format would be, you can take this average, you can retain this average receivable in the numerator and take this 365 to the denominator. So when you take this 365 to the denominator, what do you have? Net credit sales divided by 365. What is that? This is average daily sales. So average receivables divided by daily sales, daily credit sales. Then you are straight getting how many days of credit sales are there in the receivables on an average. So this is like average receivable divided by daily sales. Then also you're getting this. So this format, this is one format. This is nothing but this format and this format and this format. All these are interrelated. You know it actually as such. So this kind of information, like if they are giving you average receivable turnover ratio and asking you to find the collection period, you just need to divide. If you want it in days, 365 divided by receivable turnover. If they are giving you daily sales, then you can just divide the average receivable by the daily sales. You will get how many days of sales are there in the receivable. So all these forms should be very familiar for you, because this is from this relationship. You need 365 days or 360 days. If they are saying you assume 360 days in a year, that means every month has got 30 days, means 30 into 12 is 360. But they don't say you can assume 360 or 365, but normally it is 365 days in a year. So you need a good 365 days to generate the sales. Then this is the formula for that. If they are saying that okay, their sales are generated or if I assuming a 5-day week, like or something like 250 days in a year, assume that, then you have to assume that, right? So you have to really go with. So normal assumptions are 365 and 360, but sometimes it is not uncommon to see 250 days or even 200 days. So you have to really do accordingly. And weeks concept also you can have. So you understood this forms you can have. Now the same type of formulas you can really go for inventory and for accounts payable. The same type of concepts. Let's take inventory. What is the inventory turnover ratio? Turnover divided by any turnover ratio, turnover divided by inventory. But then you have to think to have a numerator denominator parity which is more reflective of how many times you are turning over. So if you take that, the denominator is average inventory. Inventory is valued at cost. So sales also, it is not only credit sales which is consuming inventory, it is a total sales. So don't go for credit sales, you should take that total sales. But then when you relate the inventory to sales, what is more relevant is the cost of goods sold. If it is available, definitely it is available in a published financial statement. So you should take cost of goods sold because receivable doesn't have any profit component in it. So the turnover also you should take without profit component. Then only there is a good parity between numerator and denominator. So the turnover for this receivable turnover ratio purpose ideally should be cost of goods sold. But then ideally, this thing, if the information is not there, you have to take sales. So cost of goods sold divided by average inventory is inventory turnover ratio. Then inventory holding period or inventory days or inventory holding period in weeks or whatever. So that measure, if it is in weeks, 52 divided by inventory turnover will give you the holding period. If it is in days, you want it 360 divided by, so let's take days, 365 divided by inventory turnover. This is one way. Another way to approach it is cost of goods sold is for 365 days. So how much for the average inventory? And you can really have the same way. Keep the average inventory here and take this 365 to the denominator. Cost of goods sold divided by 365. What is that? Daily consumption. Right? So any of these three forms you can have it. But only thing you should remember, when it comes to inventory ratios, inventory holding period ratio, inventory turnover ratio, if you have the cost of goods sold, you should take that. And it is not credit sales, it is the total sales. So those things you should really. Same way, let's do the accounts payable ratios. What is accounts payable turnover ratio? What does it show on an average? How much time, how many times your accounts payable is turned over? Like for given level of liability of accounts payable, how much is the total purchases you can make? So the turnover there, accounts payable turnover ratio, when you take it, turnover divided by average accounts receivable, accounts payable, but accounts payable is for purchasing goods. The purchases is same as the cost of goods sold, provided there is no change in the beginning inventory and ending inventory. But otherwise, what is it actually like? Your relationship vendor, the real compatible item for the turnover there will be purchases. But actually speaking, only if you go for credit purchase, you will generate accounts payable. So it is credit purchases divided by average accounts payable. But if you are not given credit element, then total purchase. But if you are not given any purchases number, it is again the sales. So you have to really trade off the accuracy level. But actually, this is net credit purchases divided by average accounts payable. That is the accounts payable turnover ratio. On an average, how many days you take to pay off your accounts payable? You should definitely see that that is within the credit period. Otherwise, your relationship with your vendors will be strained. You should see that. Okay, same ratios, other ratios, like if you want the same the accounts payable days, if you want, it is 365 divided by AP turnover, right? And you want uh, another form for that, like the average accounts payable divided by daily purchase. What is daily purchase? Net credit sales divided by 360 is daily purchase. How many days you take on an average to pay off your AP? That is it. And then what is the other form I have given? 365 days for the net credit purchase. So how many days for the average AP? So these three forms you can really have. The formulas are there for you. I have finished all what you need to really learn in that study unit, subunit 1. So I still have some time, but I will wrap up the ratio discussion in the next class only. So I have finished all this theory for this. So I will do 2-3 questions, and then 8:55 like that we will wind up the class. Total asset turnover, working capital turnover ratio, all that we have seen. Let's do the questions. Minus inventory is quick asset. That divided by current liability is asset test ratio. Right, from there you will get if these two numbers are given, you can immediately find the ending inventory. So you have to really see current ratio is equal to, this is a common examination question, so you should really know current ratio is equal to current assets divided by current liability. Quick ratio is equal to current assets minus inventory divided by current liability, right? If both these ratios are given, you can really see, you can derive it, you can really see if both these ratios are given, what is the difference between these two, right? You have to really see that. So what is it? Current ratio minus quick ratio. Definitely your current ratio will be higher than, which one will be higher? Which one will be higher? Your current ratio or quick ratio? Which has got the higher numerator? Denominator is same. So quick ratio will always be less than the current ratio. It can be equal when there is no inventory. Okay, so current ratio minus quick ratio will be equal to current assets minus current assets plus inventory divided by current liabilities, right? This minus this. So you can develop a useful relationship which is really good for this difference between these two ratios will be equal to I divided by current liabilities. So inventory is equal to that difference in ratio. You should really have this in mind, because at least one question will be there from this relationship. That time don't work it out. The difference between current ratio and quick ratio into current liability will be equal to inventory. Okay, Just write down somewhere. This is a very useful relationship. But this is an assumption that there is no other assets. But then that assumption is valid for at least one examination question, so it is worth remembering. So current ratio minus quick ratio is 3.5 minus 3, it is 0.5. 0.5 into year-end current liabilities 600,000 is 300,000. So you will get your inventory, ending inventory as 300,000. You understood how I did it? Using this relationship. 3.5 minus 3, it is 0.5. 0.5 into year-end current liabilities 600,000, I is equal to 300,000. Now it is given beginning inventory is given 500,000. What is the average inventory? Average inventory is 300,000 plus 500,000 divided by 2. That is 400,000. You are given inventory turnover ratio. Cost of sales and cost of goods sold are synonyms. You should really see. So cost of sales or cost of goods sold divided by average inventory equal to 8. So what is cost of goods sold? 8 into average inventory. 8 into average inventory, we have just found it out as 400,000. 8 into 400,000 is 8 into 400,000 is 3.2 million. C is the answer. But it's a very typical question. Now it is with the inventory turnover ratio, but then if you are given current ratio and quick ratio, immediately assuming that there is no prepaid asset or that, you can find the year-end inventory. That's a year-end inventory because these ratios do not involve any income statement number. But then sometimes you may take that for the average also, but here it is beginning inventory given. So you have to take that beginning inventory plus ending inventory divided by 2 as the average inventory and use that in the inventory turnover ratio. You will get that. Two things. One is cost of sales. Strictly speaking, in cost of sales may be having some other meaning, but for all ratio analysis problem, you can really assume that cost of sales is same as cost of goods sold. Next, do this problem, then give me your answer in the poll. Solved in the same way which I have told you, but then here the question is to find the net sales when you are given cost of goods sold and GP margin. 1 minus GP margin is the cost of goods sold percentage. 40% is the GP margin, means 60% is cost of goods sold percentage. Cost of goods sold divided by cost of goods sold percentage will give you the net sales. How many of you have given the answer? Nobody? It was so simple. I gave you the relationship. You can find out immediately how much is the inventory. Current ratio minus quick ratio into current liabilities is the inventory. Here there is no beginning inventory, so I have to take that ending inventory as the average inventory. But it is also given that the difference between average and ending inventory is immaterial. Even if it is not given, you have to assume the same thing. But it is given that the difference between average and ending inventory is immaterial. So ending inventory is same as average inventory. So you can put that in the inventory turnover ratio. Cost of goods sold divided by inventory, what you found out, is equal to 8. So cost of goods sold is equal to 8 into that inventory. That is the cost of goods sold. You are given GP margin, that is 0.4. So cost of goods sold percentage is 0.6. So that COGS divided by 0.6 will be equal to net sales. Rahna and Sami got the answer. Subin also got the answer. Rahul has given the answer. Okay, so that is 60,000 is your ending inventory. That is same as the average inventory, right? It's given, but even otherwise you have to assume. And the cost of goods sold divided by average inventory equal to 8, right? So cost of goods sold is equal to 8 into inventory, right? No? So how much is it? 60,000 into 8, 480,000. This is the cost of goods sold. There is a choice here. Don't take that. What you have to find out is the net sales. That is 480,000 divided by 0.6. 1 minus GP margin is the cost of goods sold percentage. 480,000 divided by 0.6 is 800,000. Choice A is the answer, right? That is it. So it's time. So see you there day after tomorrow. We'll be winding up this section. So see you there. Bye.